Hello, hello, hello. I hope everybody is having a great week. My name is Stephen Mead here with Domicile Real Estate for people who love houses. This is our Southern California housing market update for August 24th, 2021. Something that strikes me about this, I know we didn't do a big sort of anniversary, but we have been doing these videos for almost a year and a half. And I am struck by how slowly 2020 went and how quickly 2021 is going. I can't believe that we are already almost to Labor Day weekend, just about a week and a half away. Anyhow, wanted to kind of jump right into the stats, and then I'm going to kind of talk a little bit about my personal answer to the question that I get asked most often, which is what would I do if I were personally acting as a buyer or a seller? Of course, I give you all the caveat. That's me. I'm not necessarily you, and I might make very different decisions than you would, but we're going to go over that towards the end. So let's jump right into the statistics, and I'm going to kind of talk about, what we see going on here. So the first thing I want to talk about is some good news if you are a buyer, right? Especially if you're in that entry-level price category under $1 million. Again, we saw a little bit of a rise in inventory, and I think it's just important to look at how much better the inventory is versus where it was at our low point. These might not seem like huge changes to you, but I can tell you, looking in the marketplace, it makes all the difference in the world. If you're a luxury buyer in that $1 to $2 million category, you also have seen some inventory improve here, maybe not quite as much as we've seen in that lower price category. So definitely bear that in mind. I also think the luxury market didn't get beaten up quite as badly on inventory this spring either. So if we're looking here, and I haven't done this in a while, when we try to measure a lot of the things on this, what we're trying to do is really measure supply and demand, or really more accurately, we're trying to measure market desirability versus market supply. And we do that we approximate that through two things. So what you're looking at here is our 14-day, this is our 14-day new listing. So this would be measuring our supply in the marketplace. I think what's interesting about this is just looking at how steady these numbers really tend to be. We've really been playing in this zone almost the whole time. We've had some ups, we've had some downs, but really the supply has remained steady the whole time. That's really shocking when you think about it, right? At least on the face of it, because you would expect with rising prices that supply would go up, right? That's what normal economics dictates. The problem is, sellers have had a little problem to contend with, and that is where are they going to move to? If you look down here in our luxury market, same thing. Very steady supply. We got that kind of initial bump up as we headed right through February there, and then it really has kind of stayed in the same zone. It looked like things were heading up, and then we learned that was just a little bit of a blip on the radar that we saw through here. I think that was a bit of an artifact of the 4th of July weekend that we see showing up in that data. Now, the flip side of this, right, is if we're talking about the supply of houses, we want to talk about the number of houses that have gone into escrow. So when we see that our inventory has gone up, right, back here, inventory is up, but we look that our escrows is down. What does that mean? Something that I've said a lot of times in this discussion is I've talked about the notion of a supply constricted market. I don't necessarily think we are in a largely supply constricted environment anymore. I think that supply has gone up a little bit, and now we are at maybe a bit closer to an equilibrium of supply and demand in terms of the numbers of houses that are out there. So coming back here, again, we see that this new escrow number has dropped a little bit. I mean, it's still really within this range. What you see is kind of a peak, and then if you were to draw a trend line, you could see kind of a little bit of a gentle slowing. What I find kind of fascinating is that we don't really see that same thing over here in our luxury $1 to $2 million market. Maybe indicating that some of these people are operating off some sort of different facts and different assumptions. So finally, we have our absorption rate, right? And this is kind of our quick and dirty, how competitive is the market out there? You all have heard me use these. these grades before. 70 to 80% is a seller's market, 80 to 90 is a very strong seller's market, 90 plus is just insanity. And what you see here is kind of just a gentle decline as you go through here. If anything, it's kind of stabilized out a little bit actually in the last month or so. We're right here in kind of the mid 80s, still a very strong seller's market, but not an insane seller's market. If you look at our prices, and again, I want to give that little caveat, these prices are 6 to 8 weeks old. What do you see here, right? In our high end, you see prices rising rather quickly through the beginning of the year, and then kind of really holding a little bit more steady, maybe some inflationary level increases. If you look here to our median, right, we see that one accelerated through the spring and as a gentle upslope, and our entry level has also accelerated through the spring. It has maybe even a little bit stronger of an upslope, though I'd say probably in the last month or so, it looks pretty flat here. I'm not seeing huge differences in the last couple of months in there. Remember though, these are 4 to 6 weeks old because these are based on properties that have closed. Closed data is inherently 4 to 6 weeks old because it is based on contracts that were negotiated 4 to 6 weeks ago. So finally, this is kind of another little thing that we use to kind of measure sort of market competitiveness. And I like this one because I think it shows some long-term trends. And that's that percent still active after 14 days. And what this is higher is a less competitive market. I think you can clearly see things bottomed out here. And then they've been on this kind of gentle rise ever since of reducing overall competitiveness in the market. Finally, I want to talk about this because I think finally something I've been predicting for probably about a month, maybe even 2 months now, is finally starting to come true. When you look at the ratio of closed prices to list prices, what you're really looking at is this relationship between where sellers think their properties are worth and where buyers think the properties are worth. So whenever you get wildly over list price, what it means is that buyers are on the cusp of the market and sellers are playing catch up, meaning that buyers are willing to clearly pay more than the sellers think their house is worth. When you start to see this go down to a more normal level, it means that market has kind of started to catch up, right? That no longer do you see this huge disparity between where the sellers think the prices are, where the buyers are. And I'm going to give you a really big caveat to this. This is a very psychological figure, and it is also based somewhat in geography. In certain areas, namely the San Fernando Valley, I'm convinced that I see properties that are being way overpriced. and it's like someone just, looked at what their neighbor sold for and said, I want another $150,000. Not really a lot of logic in that. In the Orange County market, though, it's kind of the opposite, right? I think you see quickly, you're starting to see that there's a lot more closer to an equilibrium. And look at what we have. We have this close to list price ratio starting to drop. I mean, we peaked over 104 here. In both of these categories, I think we've got a little bit of a downward trend line. It's a little bit more pronounced in our under $1 million category. Days on market. So, one of the reasons why we look at these days on market statistics is because I think there's this idea that if there's some sort of market slowdown or crash or something like that happening, that it's going to show up here and that you're going to get some bit of a warning, right? Things are slipping. I want everyone to just bear something in mind for a second. And that is when we see the numbers down here at 20 days or below, that's not normal. That's not even close to normal. And in fact, you could even argue that these numbers are sort of insane and unsustainable. Buyers simply won't put up with having such little time to make decisions. And, there's this term being thrown around called buyer fatigue. I think buyer fatigue is real and it shows up in a lot of different ways. And one of those is buyers feeling like they are rushed in this market. And so if you look back here, say in January, look at where we were. So do I think we kind of hit a bottom here and there's a very gentle upswing? Yes. But I want to emphasize that word gentle because I don't think this is a market that is making rapid moves. I think this is a very steady and stable market for the most part. Pretty much a similar story on our $1 to $2 million here. We see kind of this bottoming out and then maybe a little bit of a trend line of a rise. But look where we were compared to, say, even in the middle of February, right? I mean, just way lower, way less than that, way below any sense of normality. This is still a competitive market. Don't make any mistake about that. And then we have our affordability chart. This is always one of my favorites because I think really this is the canary in the coal mine. And what I mean by that is, we talk about rational and irrational markets. We talk about sustainable and unsustainable markets. When I start seeing this affordability number start to shoot to the moon, that concerns me when that happens. But if you look, we are staying right in this tight range of 110 to 115%. I think that's where our market is presently happy. That is sort of an equilibrium part of some sense of sanity. And just again, as a reminder, this means we are running about 113% of our 13% higher than our June 2018 number, and that is the payment on a median priced home. I do think that wage growth since June of 2018, that was over 3 years ago now, is somewhere in that 10 to 13% range. I don't think we are out on some dangerous precipice of pricing. Yes, nominal prices of homes feel expensive, but the reality is the payments are not. And then we have our interest rate graph. I think a lot of people thought that we would start to see a trend line here towards 4%. That has not yet materialized. I don't know if that's going to materialize. We did have a little bit of a rise. I think that might have dampened some of the demand a little bit. This past week, they dropped slightly again. So, if I'm going to give you an idea, remember, especially in that entry level, I think our market is very reactive to interest rates because that really hits where the payments are for consumers and they make a decision. So now we're going to talk about what would I do. And, what I would do now is probably different than what I would have done 10, 15 years ago. One of the things that I get asked a question about a lot is, should I wait for a better market? And that can mean either a better market in terms of there's more houses available and it's less competitive, or a better market in terms of prices are less, or a better market in terms of interest rates are lower, right? Like those are the things that signify what's a better market. I don't think that's the right advice right now. And the reason being is I see a lot of pros and cons to waiting, and I think they're equally weighted, meaning for every benefit you could get by waiting, that could also turn around and be a negative to you, right? What if interest rates rise and you're priced out of the neighborhoods that you've been looking at homes in? That's a very real possibility that could happen. So, instead, the advice that I give to others, and I think the advice that I would follow myself is, I'm going to be a pickier buyer in this market, right? And I think a lot of buyers agents, if there are any buyers agents watching this, you're going to hate me for giving out this advice, but we have a little bit more inventory. And I think if you are a buyer in this marketplace, you owe it to yourself to really think about what you want that is a reasonable expectation for your budget and price range, and not just get the first house you think you can get your offer accepted on. I think it is worth it to be a little bit more strategic about that. Some of the things that I know I would be thinking about in a market like this, I'd be thinking about what's the future rentability of this property. I'd be thinking about, is there future expansion opportunities? Is this property going to continue to meet my needs? Or am I looking at this as a very temporary purchase? I think just in any environment, but especially this one, think about a property that works for you both in the short and the long term. If there's something like that, I would definitely go in that direction. Now, if I'm a seller, right, here's something that I think about as a seller. The number one thing to think about when you are a seller in this marketplace is, where are you going? And I think most sellers have been very smart. And that's the reason why we don't see tons of listings on the market despite the prices, because sellers are smarter and they're thinking about, where am I going to go? And that's really the calculus of that decision. I think that just selling because you think prices are high, I don't know if that's the right advice right now as a seller. For the exact same reasons that I think waiting for a buyer is not necessarily great advice right now. I think there's a lot of downside risk for a buyer to wait. I think there's a lot of downside risk for a seller to put their house on the market just because they think prices are high. I think if you're a seller, the smart thing to do, and the smart thing I'd be doing, is I'd want a strategy. I'd want to know, where am I going to go? I'd want to know that I was right now, I like that our market is a little less than hyper competitive. I think I could actually get contingent offers accepted. I might not have to sell my house first right now. It's definitely easier. And if you're looking for a needle in a haystack, you probably still should sell your house first to not miss out on that perfect dream home. But if your goal is I need more space, I need to move to a different neighborhood, I think as a seller now, you actually have a lot more options and prices are still high, right? So that would be my advice as a seller is I'd really work on that calculus of where am I going to go before I made the decision to put my house on the market and sell it right now. And we love the questions, we love the comments. If you are looking to buy or sell real estate in Southern California, especially Orange and Los Angeles counties, we would absolutely love to hear from you. Thank you so much for watching. Do not forget to hit that like button. Don't forget to hit the subscribe button and the notification bell. We come out with content on Monday or on Tuesdays, Thursdays, and Fridays on our YouTube channel. We're actually looking to add a Wednesday video, so I'm not sure if we'll get around to that this week. We also have some cool webinars coming up. We'll tell you about those as soon as we have them. As always, make good decisions out there. Don't be afraid to ask the right questions, and we will see you again later on this week. Thanks so much, everybody.